So, have you ever seen this happen? A company reports earnings, the headlines flash beat, and you think, great, stock's gonna pop. But then it just completely collapses? Well, that's exactly what happened with Helen of Troy. On the surface, their Q2 report looked like a win. The market's reaction, though? It was absolutely brutal. Let's dig into what really happens when an earnings beat triggers a total meltdown. Okay, let's dive right in. Here are the numbers that everybody saw first. The adjusted earnings per share, or EPS, came in at 59 cents. Analysts were expecting about 54 cents, so that's a beat. Then you look at revenue, almost $432 million, also topping what Wall Street was looking for. So by these two key metrics, it really does look like a solid quarter, a clear beat on the top and bottom lines. But, this is where that simple story ends and the real one begins. Because this was the market's real verdict. The stock didn't just slide, it cratered. It lost over a quarter of its value in one day. So that brings us to the big question, right? If the headline numbers looked good, what on earth did investors see that was so terrifying it wiped out that much value that fast? To understand that massive disconnect, we have to look past those nice, clean, adjusted numbers. We've got to pop the hood and look at the serious headwinds that are battering this company, because that's what's really going to dictate where it goes from here. And here is the first huge flashing red light. This is the GAAP earnings number. That's the one that has to include everything, warts and all. A loss of $13.44 per share. Now, almost all of that loss came from something called a non-cash asset impairment charge. In plain English, the company had to officially admit that some of its assets, brands, equipment, things it owns, were worth way less than they'd been saying. That's a huge write-down, and the market absolutely hates to see it. And the next problem this chart shows perfectly, their profitability is just getting squeezed. Gross margins dropped by 140 basis points, and adjusted operating margins got hammered, down 360 basis points from last year. Management blamed a pretty nasty mix of things: higher tariffs, having to run a lot of promotions just to sell their stuff, and what they call unfavorable operating leverage. Basically, it's costing them more to make and sell their products, and they're earning less on every single sale. Not a good combo. On top of those shrinking profits, you've got this: a debt load of nearly $900 million. Now, that puts their net leverage ratio at 3.5x, which is getting up there. A big pile of debt gets a lot heavier and a lot riskier when your core business is struggling and cash isn't flowing like it used to. But honestly, this might have been the thing that truly broke the stock's back: the forward guidance. This is management's forecast for the future, and it was grim. They're projecting a full-year sales decline of up to almost 9%, a huge drop in their adjusted earnings, and a staggering GAAP loss of nearly $30 a share. This wasn't just a signal of a bad quarter. This was them telling investors, get ready, the pain is far from over. And you have to remember, this crazy one-day drop didn't just happen in a vacuum. The stock was already sick. Helen of Troy had been dramatically underperforming its peers in the consumer staples space for a while. I mean, look at this. The broader sector was basically flat, but Helen of Troy's stock was already down over 60% in the past year before this report even came out. So, okay, things are bad. You're the company. What do? Well, they have a new CEO, G. Scott Uzzell, and he's trying to frame this whole crisis as the start of a comeback story. On the earnings call, you could hear the new CEO trying to thread this needle. He's trying to sound optimistic, but also realistic. He straight up admitted there are no quick fixes, but he's pitching this vision of a big turnaround. It's a classic strategy, but it's one that asks for a whole lot of patience from investors who've already been burned. So, what's the actual plan? Well, a big piece of it is tackling those tariffs we mentioned. Management laid out this 5-point battle plan. They're focused on moving suppliers out of China, getting smarter about inventory, squeezing costs from their suppliers, and, raising prices on customers. They say these moves have already helped, which shows they're not just sitting on their hands. Now, here's another really important detail they mentioned on the call: a potential covenant amendment. What does that mean? It means they're talking to their banks, their lenders, to basically ask for more breathing room on their loan agreements. It's proactive, which is good, but it's also a clear signal that they're worried about their financial strain causing them to break the rules of their loans. It just adds another layer of risk to the story. All right, so let's put it all together. You've got the headline beat, the absolute disaster underneath, and management's big turnaround plan. What's our thesis? What's our call heading into the next quarter? So here's the fundamental conflict playing out. On one hand, you have management telling a comeback story. They're talking about a new CEO, new energy, new plans. But on the other hand, you have the market, which is pricing in a much harsher reality. Huge challenges in just getting things done, guidance that points to more pain ahead, and a ton of debt that limits what they can actually do. So all of that brings us to our final rating, and that's an underperform. That awful guidance doesn't feel like the company hitting a bottom. It feels like them hitting a reset button on expectations. The leverage is a huge weight on their shoulders. The risk that a new CEO can't pull this off is just immense. And the fact they even have to talk to their lenders just underscores the stress they're under. We think the road ahead is going to be incredibly tough. But let's end with a tactical trade idea. While the long-term investment case looks pretty bleak, could there be a short-term play here? Look, if management actually gets that covenant amendment done, taking one big worry off the table, and then reports Q3 results that are just less bad than everyone fears, well, this stock is so beaten down you could see a massive relief rally. It's a high-risk trade for sure. You're betting on sentiment, not fundamentals, but it's one that tactical traders are definitely going to be watching. And of course, just a reminder, this is not financial advice.